another attribute is that this is a methodology that has an inherent positive expectancy. And this is somewhat nebulous. If I ask you what I mean by inherent positive expectancy, well, let me ask you, somebody, or more than one of you, what do I mean by inherent positive expectancy? I'll give you a hint. I've really already answered it previously. Yeah, James, it's basically because of what you're looking for. You're focusing on trade location, and that trade location itself, the trade location that we look for, the trade location that is formed through the auction process, has an inherent positive expectancy. It's an area where you have a greater than random probability of a sharp move. And that alone, without trying to gain the direction, if you were to just trade from certain areas and flip a coin, I think you could, I think you could probably test this. I think you would have a positive expectancy. I'm almost positive you would. I haven't done it, so I can't say I'm positive, but I'm pretty sure. So inherent positive expectancy refers to the consistent manner that an auction market develops that creates these key reference areas. And it does it in all time frames across the entire time spectrum. And then if we line up, which we try to do, the ideal trade setup is when you can identify an extreme of a smaller degree structure that is perched in a key in a key reference area of a larger degree structure, and you just have an enormous reward to risk, which is what leads to your positive expectancy in this methodology. Okay, now I'm going to, I was sitting here and I was thinking about the positive expectancy thing, and this sort of came into my mind, and I'm going to give you guys the slides, by the way. Someone had sent me an email asking me to put the slides to accompany this, and I'm going to give you these slides so you'll have definitions and you'll have all this verbiage and this, that, and the other. And I apologize for not doing that yet, but I will do it. You'll have it. But the inherent positive expectancy, I think to fully understand it, remember I said earlier, and I keep talking about it, all of this stuff is connected. It's not one piece. It's not a bunch of rote definitions. It's really all the pieces are part of a whole, and it's the whole that's important, but it's also important to understand the pieces and how they contribute to making the whole. And this trade facilitation thing is so important, and understanding what trade facilitation really, really means. I'll just read this. Trade facilitation involves price discovery. It's the price discovery mechanism of an auction market, and what it does, it involves testing and probing of a price range for value. So if I'm a big trader, an institutional trader, and I have to sell inventory, contracts, and I have all day long to do it, but I have to do it by the end of the day. I'm not going to go in, if I'm a trader, I'm not going to go in when the bell rings at 9:31 and dump 50,000 ES at the market. That would just be stupid. So what I'm going to do, I'm going to go in, I'm going to sell a few. I'm going to put some offers out above the market and see if they get taken. And I'm going to sort of get a read on value this way. Now, the people a lot of the institutional people that are doing this, and a lot of the traders that were on the floor that used to trade this way, inherently were trading an auction market, whether they realized it or not. So, and if I'm an institutional trader, I'm also aware of the obvious. There's nothing that you can know that, quote unquote, they don't know. Believe me. they're aware of the previous day's range extremes, what happened in Globex, the present average true range, VIX, et cetera, et cetera. Now, if I'm an institutional guy, I'm a young guy, young rocket scientist working for Goldman or something, I have in mind an average price I'd like to get and hopefully beat. And really the only way I can screw this up and get in trouble is if I do something stupid like dumping 50,000 on the market at the opening and I make a huge directional bet at the high of the day. Now, I am going to be a seller because that's what I was told to do, but I'm also going to work with what I have to work with, and that's time. Okay, that's a very important point. We'll come back to it or not. So whether I realize it or not, I'm trading market condition and market structure. And if I'm a good trader, I will develop over time an innate sense of how the market that I trade behaves. And I'll begin to realize what's normal and what's not. As a trader, I don't know what the range is going to be, but I know there will be a range, a high, low, and a midpoint. So at some point during the day, I'll have a feel. I'll start to develop a feel for what market condition I'm dealing with. I'll start to get a feel for what could be the high range of the day, the unfair highs from our perspective, and the low point of the day, the unfair lows. And so at this point, I have released some of my inventory, and now I can make more informed decisions about getting rid of the rest of what I have to sell during the day. And what I have done to this point, if I'm smart, and these people are smart, what I have done is I've identified relative value in the time frame that I have to trade. And so at that point, I'll work that range using the time left until the market closes, and I have to be flat. Now, I have done this. I have traded institutionally, and I have done this. In the early to mid-1990s, I did a lot of trading for Ridex mutual funds. The guy that, some of you heard this story, some of you haven't. Just bear with me if you've heard it for the 100th time. A friend of mine, Skip Vera, started Ridex mutual funds. And Ridex was the first mutual fund group that offered an inverse stock index product. It was called URSA. And the way they affected the strategy, it was an equity product, and it was hugely successful. I mean, incredibly successful, because there wasn't anything for managers, money managers, equity-based money managers to hedge or really to facilitate trading the short side of the market. And so this product was, really, really popular. Well, the way they affected their strategy was that at the end of the day, they would go in and take futures positions. So if, the managers had to have their orders in, if you wanted to take a position in URSA, which was a mutual fund, it was an inverse mutual fund, you wanted to get the closing price of the day, you had to have your order in by 3:45 Eastern Time. So at about 5 till 4 or so, usually it would be Skip himself. Skip would call me, and he'd say, Tom, and we were trading the big contract, and we were trading, trading, this was before we had electronic trading through the pit. And he'd say, okay, you need to sell 5,000 between, and I had to sell them after the cash close. So I had to sell, say, 5,000 big contracts between 4 o'clock and 4:15. Now, the idea here was that you wanted to at least meet the fair value price between the futures and the cash. And actually, you wanted to beat the cash price. You wanted to beat that. Because if I could beat that price, then Ridex would pocket the difference. And of course, if I didn't, then, Ridex would have to eat it. And, Skip Vera, I could write a book about Skip, but he was one of these just huge personality people, and very vocal, could be rather profane. And he would call me up, and he'd say, all right, use some rather colorful language and tell me that I'd better beat the price, So I'd be sitting here at 4 o'clock, and the cash would close, and I'd have 5,000 contracts to sell. Now, the market, the futures can close, especially then, it could close. And I haven't looked at the relationship between cash and futures in years. But it used to follow fair value, I think, closer maybe than it does now. I can't speak to that because, again, I haven't traded it or had a need to follow it. But that was one of the few things that I had to work with to make the trade decisions to get rid of these contracts or to sell these contracts. Actually, it was usually an opening position. I'd have to close. I'd either buy or sell, but 5 or 10,000 contracts. And so this process is exactly what I would do, except that instead of having all day to do it, I had 15 minutes to do it. And so there's no way in the world I would go in and, dump or, take 5,000 contracts down at 401. I had to work the contract, and I would work the range. I would work the range that was being established in, the period between 4 o'clock and when the market closed. And I did this, every day for years. And sometimes we would sell, just a few. And then sometimes it might be 15 or 20,000 contracts if there was a big move in the market up or down. And I'd have to, buy 15 or 20,000 or sell 15 or 20,000. And again, this was before you had electronic trading. So it wasn't just like point and click and I knew what was going on. I had to work orders. I was on the phone with a clerk who was arbing these things into the pit, and I would have to keep a tally of what was going on. And one of the things you would do, you would say, okay, sell 500 at 1820 OCO MOC. In other words, what that meant was sell it at 1820. The handle was 18. The price was 20. That was the fraction. And if it didn't go off at 1820, then you'd sell it market on close. It would be OCO MOC. So one cancels the other MOC. And that's how I would sort of work the range, this 15-minute range. And by the end of the day, I'd have all these notes and tallies and of what I'd bought or sold. And obviously, occasionally, I'd oversell or I'd overbuy, but that's just part of the process after a while. But this is how institutions trade, or a lot of them. I mean, there's more than one way institutions trade. But one of the things that's different now about how institutions trade is that, it could be the institutional trader's name might be John or Sally, or it could be Hal or Sal 3000, because you have this VWAP stuff now, value weighted average price. It would be, I think, I don't program, so it's easy for me to say what's easy, but I'm guessing you can program a computer to to let out however many contracts over a period of time based on a formula that gives them a standard deviation of 5 or 10% or whatever of the average price during the day. I just have to believe that exists. So I don't know how much of this is done by the individual traders now, but it is being done, and it's regardless of whether it's done by a person or it's being done by a computer. This is the process. Now, it's important for you to understand this because this is what's going on. Most of the trading that you see in there is not, a whole bunch of retail traders trading against each other directionally. It's institutional business. It's institutional trading. And most of it's not directional either. I've talked about this. You have the high frequency stuff, and then you also have, the correlation trade. You have all this stuff going on. Now, that that seems to be lost on traderland, retail traderland out there, because there's this misconception that, you know, we're all sitting in our den alone trading against each other. Well, we're not. You know, the retail trader is being picked off right and left because of the way they trade. You, however, if you understand the process and you know what's going on, it will make you increase, it will highlight the importance of being selective where you trade, and it will help you to realize one of the true edges you have, which is to not trade. So, what does this have to do with inherent positive expectancy? Well, everything that I just said. The inherent positive expectancy is for you to understand why there are certain places you just do not have an edge, and that you must wait until you do. And if you're patient, you'll have that opportunity in any market every single day. You know, if you just choose to be stubborn and only trade the S&P Mini, you can trade the S&P Mini based on this concept every single day. Some days are going to be much tougher than others, but you can still trade it this way. You know, the purpose of the market is to facilitate trade. You know, that's what that institutional trader is doing. He's just playing the range. He's not trying to be a hero. You know, he doesn't have to, he's not trading directionally. He has inventory. He has to either accumulate or he has to disperse. And he's using the market to do it. You do not want to be a trade facilitator. You don't want to be, if you're a trade facilitator, all you are is a liquidity provider for the HVNs. You're feeding them. They love you. You don't have to trade. And that is a monster edge over those who do. And nobody uses it. You have to use it. You use it. Now, this facilitation process, as you begin to look at the market, price will move away in any given auction. And when I say auction, I'm talking about time frame. An auction exists on a 1-minute chart. An auction exists on a 5-minute chart. An auction exists in the day session. An auction exists in Globex. And then there is the larger degree auction of development that is ongoing. It's one giant continuous auction. But in a given auction, prices will move away from unfair prices in a consistently sharper manner than the price action of regular rotation. This is that the thing about trade location gives you the opportunity where price is more likely than random to move sharply. This is why. So, and in a mature auction, price will move to one extreme or the other with the increasing probability of the transition into vertical development and initiative move. This is not just a concept. This should drive your strategy and your tactics. You will hear me say in the DBSA, in the reports at night, you'll hear me say this in the pre-market reports, you want to be trading for the initiative move here. That's just what I'm saying. What I'm telling you is don't fade the extremes. You know, don't be fading short-term conviction. Try to identify short-term conviction and go with it. So again, unlike the institutional trader, we don't have to trade. We can wait until we think we've identified the right trade location that gives us an edge. And it's a huge edge. Are we always going to be right? No, you don't have to be right. And we're going to get into that too. This does not require perfection. But it does, if you're consistent in attempting to do this, you'll get better and better at it. But this is why you have to do this. This is the essence of this entire course. Is the essence of everything that an auction market trader does. So trading from extremes has an inherent positive expectancy. Is trading being facilitated at the extremes? No, it's not. We don't want to be a trade facilitator. Not for long. You know, if you're trading one market more than 4 or 5 times a day, you're a trade facilitator. You don't want to be that. And actually, 4 or 5 times, you need to sit down and have a discussion with yourself, the same market.